Hi friends, today in banking basics we will see about loan module. Uh, now, earlier we have seen how the banks making money. Basically, customers deposit the money into their account, either in the form of deposit or in the savings account. Whatever money is there in the deposit, for that money, bank gives the interest to the customer, and then bank has to make money out of that deposit. So that deposited amount is given as a loan to the customers. That is the lending process. So the deposit interest rate is lesser than the lending rate. So that is the margin. That is where the bank makes money. So whatever the deposit interest rate is slightly lesser than the loan rate, and whatever deposited, that amount has to be converted to loan. Then only bank will make money for the margin amount. At least 80% of the deposit has to be converted to the loan. Accordingly, the bank also sets the lending rate. And we'll see what are the types of loans available. Here I have just listed a few type of loans: personal loans, mortgage loans, auto loans, business loans, and students loan. For the personal loans mainly given for individual customers, retail loans. Similarly, the student loan also retail loans. And then next, mortgage loans. This is also primarily for the individual customers, plus the commercial loans also might be there for building a complex or building a factory kind of thing. So, uh, mortgage loan is something like, there is some security. The building or the asset is pledged against the loan, and bank gives the loan for that. And mainly this for the longer term. And then auto loans, this is for the shorter loan. Even here also, vehicle is pledged. This is for individual and corporate also is possible. Individual for one vehicle, individual may take loan, and for when it comes to corporate, multiple vehicles to run the business, they can take a loan in auto loan, and this is also for a shorter time like personal loan. And then last one is business loan, where to run the business or for the trade purposes, they take a loan. This is again for a shorter term. Usually for business loans, for corporates and for small entities, bank prefers to charge a more interest rate. And when it comes to the personal loan for salaried people, where there is a less risk, based on the risk factor, uh, interest rate is set. For the same amount, for the same personal loan, one customer might get a good rate, one customer might get a bad rate. That is purely because of the customer credit history and the risk factor. If they are employed with a government entity, or a very secured entity, then they get a very good rate. If somebody is working in small companies where more risk factor is there, then the interest rate is more. So this is how the interest rate has been set at the every loan level or based on the customer. Now we'll see what are the various stages in the loan processing. When it comes to the loan processing, first will here I have given the step wise. First step is the loan application, where customer applies for a loan. He gives his particulars and proof of income and everything. So based on that, by seeing the customer document, the pre-approval is taken. Then this pre-approval is done by the bank team at the first level of investigation team, and then the manager approves the this one, and then it goes to the next stage, where customer document is verified against his credit history and then a credit bureau report. Based on that, the loan approval happens there, and then finally they collect a documentation on, because during the loan application he just submits his personal details and the rest of the details. Once the loan is approved, then they take the final document like a security check, and if any other documentation required, like if it is for mortgage, then customer has to give the MOD, and then asset certificate registration and then has to be done. And then loan processing happens. In this loan processing, whatever the data that collected, that is fed into the system. Once the data is fed and then approval is provided within the system, then the loan disbursement. Disbursement is nothing but crediting the amount, principal amount to the customer account. While dispersing, again, there might be some processing charges and all that will be deducted from the original principal amount, and then final amount is given as a credit to the customer account. Then the customer utilizes the loan amount that is up to his willingness when he wanted to utilize from his account. And then based on the agreement during the loan processing, there may be a repayment schedule every month or every quarterly. Usually, let us consider every month. So there will be some date agreed by the bank and the customer. On that particular date, customer has to make a payment. Whether usually it is automatically debited from the customer account where the fund is credited, or he can give a different account also for the debit. So based on that, automatically funds will be debited. And then during the loan running time, customer might come for asking for amendment of the loan, either to increase the maturity date, change the maturity date, or pre-closing, or asking for some repayment schedule or interest statement. So that kind of servicing might happen. For that, bank may charge some ad hoc charges. Not that is not in the schedule, but based on the servicing, customer might get charged. And then finally, when customer does all the repayment and then there is no outstanding in the loan, then loan closure happens. As part of the loan closure, bank will have some certain activities to report to central bank. Even and during the entire running time also, bank does reporting to the central bank what is the outstanding and how much customer has paid, customer outstanding, everything is updated to the central bank. And then as part of the final closure also, the bank is supposed to update to the central bank. So all these processes involved. To process everything, we can have two different systems. One is the origination system, and another one is the loan managing system. Origination system is primarily handles only the document thing. There is no accounting entries posted. It primarily will have a workflow to move into the next stage based on the previous stage result. If pre-approval is done, then it will put onto the loan approval. Inside the loan approval, there may be several stages to collect the documents from the credit bureau report and other verification and everything. So, and then loan documentation portion, it will ask to upload all the documents and verify. And then finally, once the loan is getting processed, so that time that loan application will be pushed to the loan management system. So in that loan managing system only, will have the full accounting and processing until the closure portion. So either these two can be managed in a single system, or we can have a two different system for origination and loan management system. This is purely depends on the bank IT decision whether to have a single system or two different system based on their need. Because some banks mainly focus only on the retail loan or corporate loan. Some banks may focus only corporate, and some banks carry both. And based on the nature of the loans that they have, they may have many variants. So for all those things, they may go for different systems. Now let us see what are the types of interest rates that is available in the market. Because as I said, how the bank make money, why they are giving loan to the customer to make money, how they are make money by putting the interest rate. So whenever we go to the bank, we can hear two things. One is the flat rate or fixed rate, and another one is a reducing rate, reducing interest on reducing balance. Because as we all know, bank will charge EMI, equated monthly installment. When it comes to the flat or reducing rate, we will have the EMI amount which is same across the all schedules except the last schedule. Last schedule alone will have a small difference, that is due to the rounding thing. We'll see in the next slide, how the fixed rate and variable rate works. So fixed rate mainly For the entire tenor, the rate is fixed. If the rate is 5%, then for the entire period, they will apply 5% of interest rate. Here the percentage is on the annual rate. So if the loan is for 24 months, then for 24 months, the rate is applied on the entire principal. And then principal and interest is summed and divided into 24 to arrive the EMI amount. In case of reducing balance, since customer is paying interest plus principal on every repayment, so the next month interest is calculated on the reducing principal amount, because in the previous month he paid some portion of principal. That principal is reduced in the total principal, and then a new outstanding principal is arrived. The next month interest calculated on the reduced principal amount. In this case, we have a common formula available in the market. The same formula is used to arrive the EMI amount, and then every month schedule is created. And these two are the very common. And then third one is annualized percentage rate. This is calculated at the bank side internally to arrive, what is the total profit that they are making. So to do that calculation, they arrive this particular rate. This is not exposed to the customer most of the time. So we can ignore. And then next one is prime interest rate. This is mainly for the customer who is having a long relationship with the bank, who have very good credit history. As I told you in the earlier, some customer might get good rate, some customer might get bad rate, because based on their credit history, current working nature, current employment. The employment is with the government entities and all, then they usually get a good rate because their salaries are certain, they will not have much problem. So the return also is very good for the bank, so they might consider to give at the better rate to them. In case of small companies, the risk might be high, because they may be fired anytime, and if company doesn't perform well, then they don't get salary. So based on that, bank might willing to charge more interest rate on the customer to get the returns as early as possible. And then next thing is the simple interest rate and compound interest rate. As we all know, like more common thing is the simple interest rate. Whereas if a monthly system they are calculating, then they don't accumulate the interest on the interest. They don't do calculation interest on interest. Whereas in the compound interest, the interest on interest is calculated based on the compounding frequency. If it is quarterly repayment, if I say monthly compounding, then monthly interest, whatever is calculated, that is taken into the principal, and the next month interest is calculated along with the principal plus first month interest. So similarly, the third month principal plus 2 month interest is added, and then considered as principal, and the interest is calculated on the compounded value. But the main thing is the simple interest is a very common thing. Compound interest nowadays is not there. Only in the micro finance market, only this compounding things work. Nowadays, most of the central banks are not encouraging banks to go for the compounding interest rate for the loans. Now, next, we will see one sample calculation on how the interest is getting calculated. We all know what is the simple interest formula, PNR by 100, where P is principal, N is tenor, and R is rate of interest. Rate of interest, if it is 5, then we will say 5 by 100 is that's why we call it as PNR by 100. But here I have given a calculation for how many days, because whenever you take a loan, it is not necessary that, in a month, every time you will get 30 days. That is very certain. Like there is always a change, 30 days, 31 days, 29 days, 28 days. So whenever there is an EMI interest is calculated, a customer is supposed to be charged only for the number of days that he had the fund with him. So every month calculating the interest with the same number of days is not the good thing, good practice. So banks prefer to charge based on the actual days that is spent. So here I will take a case, 100,000 is given to the customer, 1 lakh, and rate of interest is 5%. Let's say if customer is calculating the interest for 30 days, and then the rate I've given, because sometimes in a year we'll get 365 days or 366 days based on the leap year. So the 5% whatever I said is for the year. If it is 365 days, then the for 365 day 5%. If it is 366 days, then the 5% is for 366 days. Okay. We'll see the difference here. You see our first calculation, the number of days is 30, days in years that 365. So according to this formula, the interest will come to 410.96. If 31 days are there for the same 365 days calculation, it will come to 424.66. So this 23.7 is the 1 day interest. And if it is 30 days, and if the days is in a year is considered as 360, because there are multiple things like 360 days or 365 or actual the denominator. These are the common practices in the above one also, whether it is actual number of days or 30 days in a month. Because to make it plain vanilla case, what bank might say, okay, I will take every day, I will consider every month as 30 days. If that is the case, then in the denominator, they will put 360. So in this case, what will happen every month, system bank might charge 416.67. If you see with the first scenario and third scenario, the interest is little higher for third scenario. Why? Because this 5%, the percentage is same, but the denominator, if you look at the maths formula, the denominator, if the number are more, then the output is less. So if the denominator number is less, then the output is more. So that's why if I consider the number of days in a year 35, then I'm getting 410. If it is 360, then I'm getting 416.67. Whereas if it is 366, I'm getting less interest. So little tricky, and whoever understand this max very well, for them, it should be easy to understand. But these numbers are little tricky over here. If the interest rate is for actual number of days in a year, then that is a very, very good. If they say I'll put 5%, but with 360 days, it might look attractive when we say, okay, I will charge only for 360 days, not for 366 days, but it is resulting in a high interest rate, high interest. Now, earlier we have seen the reducing rate and fixed rate. Now we'll see, what is the main difference over here. We'll see a sample calculation. If you look at here, I've taken the same thing like 100,000 is the loan amount. And first we'll see the reducing balance. Second, we'll see the fixed rate. Reducing balance here, if you see the EMI amount is same 8722. First month interest is 1,240. Second month is reducing. Why? Because my loan balance is reduced, because first month he paid 7,482 for the principal. So next month I am considering 92,518 only for the interest calculation. That is why my interest is getting reduced. So likewise, if I look at the last month, customer is paying only 154 dirham, 154, whereas principal is more. Whereas in the fixed rate, the first month, how the interest is calculated, upfront, the interest is arrived for the entire 12 months with 8.5 percentage. 8.5 percentage is nothing but 8,500. 8,500 is divided into 12. So every month, 708 is what deducted. So first month it looks, my interest is very less compared to the reducing balance. But if you look at the further, the entire schedule is paying 708, but in the reducing balance, his interest is getting reduced and his principal is getting increased. Uh, so, whenever customer goes for a loan, if a salesperson says 8.5% is fixed and 14.88 percentage float, reducing balance, you might think like if 8.5 percentage looks less, but both are same. Suppose if salesperson says, sir, 12 percentage is the reducing balance, but 8.5 percentage is fixed. which one you want to go. If without seeing the entire picture, if you agree for 8.5 percentage, because for you, you'll the only numbers only you will hear it 8.5 percentage or 12 percentage. So 8.5 percentage looks less, like so you will prefer to go for 8,500, 8.5 percentage. But you see that there you'll be paying 8,500. If it is 12%, here you will be paying only 7,800 or 8,000 only. 5,500 will be saved. But without seeing the entire picture, if customer is agreeing, then it's a profit to the bank because a salesperson convinced the customer with 8.5 percentage, and customer has not realized that he is going to pay more amount. And now we'll see the next and here the number 1 to 12, this is called payment schedule, because first he is getting disbursement, and then for 12, these 12 schedules called payment schedule, repayment schedule. And as I said, 8,500 is calculated for the total tenor upfront, and then that is divided into 12 and spread across the schedules. Now we'll see a difference between fixed versus floating rate, variable or floating, we call it as. So here I have taken the same reducing balancing method to showcase here. Same 100,000, 5% yeah, rate of interest for the reducing balance. We have already seen how much that customer is going to pay. Here I have calculated based on actual number of days in a month. So customer is paying 2,675 as the in. And when it comes to the variable pay, variable rate, why I'm saying variable rate here, the first statement, you look at the interest rate is fixed for the entire period, but in the variable rate, based on the market condition, it is attached to some you might have heard the RBI or central bank always keep changing the interest rate, so that will reflect here. Usually, this is given for the home loans. So only for the sample purpose, I have taken only 12 months schedule. But in a home loan, first 2 years always fixed, and then based on the real market conditions, then they apply the no, they will apply the variable rate. Sometimes it reduces, sometimes it increases. When you take a loan on the peak time, peak demand time, that time interest rate will be high. When there is a low demand, that time interest rate will be less. Assume that during the COVID time, rate was very less. So that time monthly total interest will be less compared to the other period. So here we'll see the sample. So in the variable rate, you see the 5% is there in the beginning of the month, first of the month, and subsequently it is getting increased for 3 months. So during this period, compared to the normal rate, see here customer has paid only 350, but here he paid 385 because the rate is increased. And then the third month he paid 352, but customer here 387 is coming. See, the EMI also is getting changed because of the variable rate. We cannot have the fixed EMI over here. Suppose if you put fixed EMI, then to adjust this amount, then the remaining amount will come and add it in the bullet schedule. This will become too much. So generally, bank won't give the same EMI amount every month based on the interest. Then the EMI amount will change, and after that the rate is reduced. So here the interest amount is little changed compared to here. It still is higher because here it is 5%, this is 5.3 percentage. And the next month again customer is paying the additional amount here compared to here. And then here 4.5 4.8 percentage, here it is 5%, here is 4.8 percentage. Even though this is reduced, his main interest here and here you look at because of the 4.8 percentage, here we can see the little reduction in the interest amount, and EMI also is reduced compared to this because we can see like why this guy is now it's getting reduced because In both the cases, customer is paying the same principal amount. So outstanding principal at this point of time both same. On this outstanding principal, 209 for 5%, for 4.8 percentage, 201. And then next month, again, here same rate only applied. Here rate is reduced, so he is paying less interest. And then the last three schedules, again the rate are very less, so customer is paying very less interest. And then finally, if you look at here, customer has paid this much amount of 2,675. Here, customer has paid more. Why? Because in the first few months, customer has paid at very high interest rate. So that's why the overall interest is high over here. Even though last six schedules, the interest rate is less because initial time he paid with high interest rate, then customer is paying or the overall customer is paying more interest. So this is the very at the high level. What is the difference between how the fixed rate and variable rate is working? So in this, just to recap, the fixed rate is five. The rate is same until the maturity date, and variable rate based on the market situation. The bank will have fixed one rate code plus the margin will be there. So accordingly, system will derive the final rate, and that final rate is applied every month. That is again, either it may be on every month or every 3 months, 6 months. That is based on the rate that is agreed with the customer, bank and customer. Okay. So here we can see the EMI amount is keep changing every month. Why? Because the interest rate was changing every month. There is a change in the interest rate during this period. Now let us look at the moratorium. There is a concept called moratorium. Here we will explain what is the moratorium concept and how it works. Let's say you are taking a personal loan for the same scenario. We are applying the loan and then it is getting disbursed on 15th December. Bank will have the EMI schedule, whatever loans getting processed on the month, EMI date will be set on 31st. Suppose if this is the scenario, then the bank might ask whether you want to recover the first EMI on the 31st December or 31st Jan. So if customer says, oh, no, no, I have some spending, so I want to make the repayment from 31st January. If he prefers 31st January because of the tenor 12 months, the last schedule will be on 31st December. So customer is having the loan from the 15th December to 31st December next year. So this is like 365 days plus 17 days extra. So this for first 17 days, the system arrives the interest of 232, but there is no schedule to charge the customer. So this 232 will be can be equally split across the month across the EMS schedules. This divided by 12, it arrives to 19.41. This will be added to the every schedule. Apart from this, earlier we have seen how this main interest is calculated based on the outstanding principal. System arrives the main interest, and main interest plus mora interest plus principal. So all together is arrived at the EMI amount. So 8,579.41 is the EMI amount. So customer every month he will be paying this much amount. In this, if you see the breakup, this is the interest, moratorium interest, and principal. So to summarize this, moratorium is something like interest is calculated for the period where customer is not having any repayment schedule. As I told you, in the month of December, there is no repayment schedule. So for this period, system has arrived this particular interest. And for this schedule, 1st January to 31st January is the repayment schedule. So for this period, for 1 month, this is the starting period is 1st January to 31st January. And then for this guy, 15th December to 31st December, uh, this is the moratorium period. Moratorium period. For this period, whatever the interest calculated, that is equally split across the rest of the schedules. Now, we might have a scenario like uh, one second. Let me clear everything. Okay. There are some scenario like customer might come and ask for a holiday period, moratorium period in the middle of the schedule. Something like now customer lost the job, or there is some festival, or there is some critical financial situation to the customer. So customer might come and ask, okay, next 2 months I cannot make a payment. I want to postpone the schedule so that customer can make a request to the bank. Bank will say, okay, no problem. Now 31st December 2025 is your maturity date. I will push it to the 29th, 28th February of 2026. But for those missing 2 months, whatever interest is calculated, that can be either split across the rest of the schedules, or he can pay it at the end of the schedule, in the last schedule. So last schedule will be little higher than the actual EMI amount. So the moratorium usually comes in the very beginning stage for first schedule, or it can come in the middle also. This moratorium in the middle, like home loans, and during our COVID time also, we might have seen a situation, most of the people lost the job. And then why they are asking for a moratorium in the mid? Because if a bank also does such a rescheduling, then there is no chance of customer going into the overdue. Because if bank is saying, okay, if your officially your repayment schedule of 31st of August is kept to 30th September, so bank also agreed that if 31st, if he doesn't make a payment, that is not treated as an overdue or unpaid schedule. So bank will report that as a normal customer to the central bank also. So no problem. So only for that. To maintain the good credit history only, this uh, moratorium can be introduced in the middle of the schedule. So that is called either postponement or this moratorium. So to the real-time world, we call it as postponement, but the earlier technical term in the bank is moratorium. Okay. Now we'll see what are the various events in the loans life cycle. As I told in the beginning, we have called origination. In the origination, we have seen loan application, pre-approval, approval, documentation. So those processes are outside the loan management system. And in the loan management system, first we'll have the booking. That is nothing but coming from the origination to book the loan. When I book a loan, I can say I'm booking a loan today, but it has to disperse or it has to initiate it from the next week. Or let's say today I'm sitting on 29th December. If I want to initiate the loan as of 2nd January, I can book a loan today, but with the effective date of 2nd January, so that the initiation will happen on 2nd January. And during the initiation, then while booking time itself, I will mention when the loan has to be dispersed. If it is a personal loan, it is a single disbursement of the entire principal amount. In case of student loan, education loan, and mortgage loan, there may be a scenario where disbursement can happen in the tranches. Tranches meaning like whenever some milestone is achieved, based on the achievement of milestone, bank may decide some percentage of the loan amount can be dispersed to the customer account, either customer account or the builder. In case of mortgage, in case of educational loan, it will be credited to the either college account or to the student account. That is based on the bank decision. And then next is accrual. Once the loan amount is dispersed, principal is given to the customer, then from that day onwards, the interest will start. So if bank want to realize at the high level, as of today, what is the income realized? So as I told you, like bank is daily calculating the interest. That interest amount is booked in the income account. From where they will debit is they will have some intermediary GL that is called receivable in advance. So that GL is debited and the income GL is credited. And during the repayment, there is a next statement. During the repayment, customer account is debited and that intermediary GL is nullified. So every time during the liquidation time, that intermediary GL will have zero balance. Income GL will have the full realized income amount. So during the repayment, customer makes principal plus interest or any insurance or any other charges. And then this repayment can happen either auto or manual. Auto mean like in India, ECS is the common thing. Either customer may have account with the same bank or in the other bank. So based on the settlement instruction or debit instruction, if it is within the bank, immediately it debits. If it is outside the bank, then the ECS request into the other bank. Based on the receipt of fund, the payment will happen. Our customer might come to the branch. Let's say if he skipped the payment is not paid, then customer might come to the branch, give the check or make the payment as cash to make the payment successfully. And once all the payment is done, and then the closure will happen. So closure can happen at the time of maturity, or customer can do the pre-closure either by taking the loan from some other bank or with his own fund he can close it. These are the normal scenarios, and there are some other scenarios will be there, like amendment. We call it as amendment. Why customer is coming for amendment? Either to increase the maturity or reduce the maturity, or he wanted to change the interest rate because now the market is good. Customer is coming with some other offer with less interest rate, so bank want to retain it. So customer loan can be changed by changing the interest rate, either increase or decrease. Or he might ask, okay, I want to change the EMI amount because it looks more now when they increase the maturity date, then EMI amount will decrease. If they are increasing the maturity date, mean customer has to pay more interest, but equal when I consider the monthly amount, then if that is less, then customer may prefer sometimes based on the financial status. Or if he want to close it quickly, then customer may ask, okay, early closer. Instead of he might ask to reduce the maturity date so that he can pay more EMI amount and close the loan quickly. And next thing is called status movement. When customer is not paying the schedule on time, or he is skipping last 3 months, he has not paid the loans. Any repayment is not done by the customer. So whatever income realized, that has to be moved to the suspense account. And because the customer has still not made any payment, customer might become bad anytime. So bank will have multiple stages internally called substandard loss, uh, something like that will be there. So based on the number of days overdue in the principal amount, if he makes the at least the interest paid, then okay, because banks will have a status like how many whether interest itself not paid or principal is not paid. If interest at least paid, then they may consider it as a current. If interest itself not paid, not paying anything, then loan has to be moved to the next stage. Accordingly, the bank has to inform the central bank also, stating these many loans are becoming bad. That is called NPA, non-performing asset, because the entire loan is considered as a right. Then if the customer is not paying, then those amounts has to be reported as a bad NPA. And if customer is not paying for 2 3 years, then uh, based on the court case and everything, finally it can be written off. So that is considered as an entire loss. Instead of making that to income, the principal amount plus interest amount, everything will be considered as loss. And next thing is ad hoc charges. As I said, during the loan servicing, customer might come for any postponement. So during the postponement, there will be some charges. Our customer might come and ask for additional document from the bank, and the mortgaged property, the original document will be with the bank. So customer might come and ask for the photocopy of the document, or he may ask for a loan statement, interest rate statement. For those things, bank can charge. So those things are called ad hoc charges. Reversal of a loan. Sometimes when bank issue a new loan to the customer, they can give an option within 1 month or within 1 week. If customer is not happy, then he can reverse the loan if the funds are not utilized. So during that time, whatever the law processing fee, whatever the insurance fee, whatever the principal, everything will get rolled back. So that loan will be treated as a closed loan, rather than stating as a closed loan. Reversal of a loan means like customer has not taken a loan. If I'm saying closing the loan, which means customer has taken a loan, he utilized and closed. So the reporting is different for reversal and closure of the loan. So reversal meaning the such kind of activity will not reflect in central bank, and that will not come in the report also. But if I'm closing the loan, then it will come in the report saying customer has taken a loan and then closed. So that's the difference. And then the rate revision. Earlier, we have seen what is the variable rate. Based on the market situation, banks might change the interest rate. So, whenever there is an interest change, that new rate has to be considered in the loan. So, that event we call it as rate revision. And then the rollover, these are not for the normal individual customers, these are for the corporate entities where they take a big loan and they keep paying only the interest, and within the agreed maturity date, customer might come and ask, okay, extend the maturity or extend the loan for another 1 year. So that activity is called rollover. So this is nothing but just extending the principal or principal plus interest as a new principal to the new tenor, but with the same loan reference number. So this is called rollover. And then we'll see what are the various components in the loan. As I told you, like main component is like principal amount. Principal amount is the loan amount, and then a processing fee. A bank might charge because they have a sales people and operations people running. So for that, bank always charges some percentage. They will have some maximum cap, 1% or 2,500, something like that will be there. And that will have some a tax also. So and insurance is for the, if it is mortgage, then it will have a property insurance, and then the loan insurance. Suppose if customer is deceased dead, then loan can be, the entire principal amount can be recovered from the insurance companies. For that, they opt for an insurance. And then the main interest, this is the like monthly interest happens on the outstanding principal. Suppose if customer is not making a payment, then that month overdue principal, bank can apply the penalty on the principal. Because customer has not made a payment, then that particular portion outstanding principal, bank can apply a different interest rate to penalize the customer. And the next one is penalty on interest. For that month, whatever unpaid interest is there, right? For that, again, interest can be applied by the bank with a different interest rate to penalize the customer for not paying on time. And then amendment fee, as I said, like postponement component, or any customer is coming with a request to extend the maturity or change the EMI amount or whatever thing. So that can be charged to the customer. And if customer is coming and asking for any statement, ad hoc statement, other than the regular statement, then bank can charge on it. And then on all above fees, based on the local regulation, tax might be there. And those taxes also can be charged to the customer. So these are the various components that mainly we come across. There may be some other components also, but these are the very common components that we can see it in the market. Thank you. If you have any questions, please put it in the comment box. I'll try to cover some more videos on entire even in I will try to cover the accounting entries with accounting entries who's debited, who's credited, and what are the various things inside. So that I will try to cover in the next videos, upcoming videos on the loans document. And I will try to go in deep. And this particular video is mainly for the, at the high level to give you the loans module in any banking application. Thank you.